Losing a spouse can have a profound effect on the future of a couple's marital home. In many cases, the surviving spouse may decide to sell rather than hold on to it for their child or children to inherit. But before listing it on the market, there are tax considerations you will want to take into account that could result in significant tax savings or consequences for certain properties. Hi, I'm Antoinette Bone, estate planning, probate, and guardianship attorney in the Dallas-Fort Worth Metroplex. And today I want to talk to you about capital gains tax exclusions surviving spouses may be entitled to. Now, the biggest concern when selling property is capital gains taxes. So, what is capital gains tax? A capital gain is the difference between the basis in property value and its selling price. The basis is usually the purchase price of the property, and if you sold it for higher than that amount, you would have to pay taxes for the amount that the property has appreciated. That increase in value is the capital gain. For example, if you purchased a house for $250,000 and sold it for $450,000, you would have a $200,000 gain. That $200,000 would now be subject to capital gains tax. Couples who are married and file taxes jointly can sell their main residence and exclude up to $500,000 of gain from the sale from their gross income, versus single individuals who can exclude only $250,000. But if one of the spouses passes away, the surviving spouse will not fall under the category of a single individual just yet. Depending on the state of residence, there's a limited time when a surviving spouse can still get the full $500,000 exclusion if they sell their house. So it must be within 2 years of the date of the spouse's death, to be exact, provided that other ownership and use requirements have been met. The result is that widows or widowers who sell within 2 years may not have to pay any capital gains tax on the sale of the home. If it has been more than 2 years after the spouse's death, the surviving spouse will only be able to exclude $250,000 of capital gains. There are also other conditions where a surviving spouse may not owe taxes on the rest of any gain. Typically, when a homeowner dies, the cost basis of the property is stepped up. This means the current fair market value of the home becomes the basis. What this means for jointly owned properties is if one of the owners dies, half of the value of the real estate is stepped up. For example, John and Mary are husband and wife who bought their home for $200,000. When John died, the property has the fair market value of $300,000. John's half is stepped up with his share of the property now valued at $150,000 when Mary inherits it. Mary's original share remains at the original basis of $100,000. This makes the new cost basis of the property that Mary now solely owns $250,000. Now, if Mary decides to sell, capital gains tax on the property will now be computed based on the selling price in excess of $250,000 instead of $200,000. This can significantly lessen the gains and hopefully be covered or minimized by the applicable capital gains tax exclusion. In community property states such as Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin, stepping up a property works differently. Since property acquired during marriage is the community property of both spouses, the property's entire basis is stepped up when one spouse dies. So let's assume John and Mary's example that they live in Texas. The fair market value of $300,000 at the time of John's death becomes the new basis of the property. When Mary dies, the basis is again stepped up. For example, if the value of the property at the time of her death is $450,000, that becomes the new basis. This is what we call the double step up in basis. This basis increase translates into a significant tax benefit for your heirs. The timing and state of residence are not the only factors that can affect taxes when selling property after a loved one's passing. At the Law Office of Antoinette Bone, we can help you understand more about the tax consequences of selling your properties after death of a spouse, and how to plan for and navigate the legal matters that need to be addressed after a loved one's passing. We understand that no two families or personal situations are the same. That's why we take a personalized approach with all of our clients. Let us guide you through this process. Call us today at 817-462-5454 or email info@abonelaw.com to schedule an appointment. We would be happy to assist you. I'm Antoinette Bone, estate planning, probate, and guardianship attorney in the Dallas-Fort Worth Metroplex. If you found this content useful and would like to see more like it, subscribe to my page, like this video, and don't forget to tell your family and friends. Thanks for watching, and I will see you next time.